All right, let's dive into something really interesting today. We're looking at the latest results from Singapore Post, and trust me, this is way more than just a bunch of numbers on a spreadsheet. It's a fascinating story about a massive company trying to reinvent itself right before our eyes. So, you see this number first, $18.4 million. That's the net profit for the first half of their financial year. And at a glance, you think, hey, not bad, right? A well-known company turning a healthy profit. But that number is not what it seems. In fact, it's hiding something much more dramatic.
Because when you peel back just one layer, look at this. The underlying net profit, which is what the company actually made from its day-to-day operations, was just $5.5 million. That is a jaw-dropping 78% nosedive from last year. So what in the world is going on? How can one number look decent while the real health check number is flashing red?
So here's how we're going to break it all down. First, we'll solve this mystery of the two profits. Then, we'll look at the headwinds hammering the company. We'll see how they're making a huge pivot, check out what the new SingPost actually looks like, and finally, see what the plan is for the future. Okay, let's jump right in. A tale of two profits. We're going to figure out why these two numbers are telling completely different stories about the company's health. You know, the whole secret is this thing called underlying net profit. Just think of it like this. It's the company's vital signs. It's the money they make from their actual everyday job, delivering packages, running post offices, without any one-off boosts like selling a building. It shows you how the core engine is really running.
And here's the kicker. That nice $18.4 million figure, it was basically propped up by a couple of one-off deals. They sold off some businesses for a $9.3 million gain, and the value of their properties went up on paper by another $5.5 million. So these two things completely papered over the cracks of what was really happening in the main business.
So if the core business is struggling, the big question is, why? Well, that brings us to the next piece of the puzzle, and it's a big one, the e-commerce headwinds. And boom, here it is. This is the smoking gun, a 63% drop in the volume of international e-commerce packages. That's all the stuff being shipped into and out of Singapore. Just think about that for a second. That part of their business didn't just shrink, it practically fell off a cliff. And look what that does to the bottom line. It's not just some abstract percentage. That volume collapse literally took their biggest business segment, which made a nearly $14 million profit last year, and plunged it deep into the red with an $4.4 million loss. That is a massive, painful swing. Okay, so your main business is getting absolutely hammered. What do? Panic? Well, SingPost's response was pretty bold, actually. Let's look at how they're trying to get leaner and much more focused. They basically went on a huge corporate decluttering spree, selling their Australian business, getting out of a big Chinese logistics firm, selling their freight forwarding arm. It was a fast and furious series of moves. They decided to pull back from all these international ventures to focus their energy and their money back home. And don't just take my word for it. The new CEO himself came out and said it. This wasn't a mistake or a sign of failure. It was a deliberate choice. He's saying they are intentionally shrinking the business right now to build a stronger, more stable company for the future. And here's the proof that it's working, at least on one front. Their operating expenses slashed by over 25%. That's huge. When you're bringing less money in the door, you absolutely have to find a way to spend less. And that's exactly what they've done. So what's left after all this cutting and selling? What does the new SingPost actually do? Let's pop the hood and see how the restructured company is performing. It's pretty simple now, really. Just three main parts. You've got the main event, logistics and letters, which is still the biggest piece of the pie by far, then a tiny slice for the post office network, but I want you to keep your eye on that 20% slice for property. It's kind of the unsung hero of this whole story. And this table, this right here, tells you everything you need to know. Look at the big logistics business. Revenue is shrinking and it's losing money. Now, look over at the property segment. Revenue is stable, it's even growing a bit, and it's churning out a really healthy $24 million in profit. This is the company's lifeline right now. It's the rock-solid anchor keeping the whole ship steady. And why is it so stable? Well, it's just good old-fashioned real estate. Their main building, the SingPost Center, is basically full. We're talking 99.2% occupancy. That means those rent checks just keep rolling in, month after month, no matter what's happening with global shipping. In this environment, that kind of predictable income is gold.
All right, so they've stopped the bleeding and they've found some stability with their property arm.
But what's next? What's the actual game plan? Let's take a look at the road ahead.
The strategy is really simple and no nonsense. Number 1, fix the core business, especially here at home. Number 2, keep finding ways to be more efficient and cut costs. And number 3, be super careful with money. It's a real back-to-basics approach.
And this isn't just talk. They're dropping a cool $30 million on new high-tech sorting equipment. This is all about getting better and faster at handling all the stuff we buy online here in Singapore. It's a concrete bet on the future of the domestic e-commerce market, which is exactly where they need to get stronger.
So to pull it all together real quick, that big profit number, kind of smoke and mirrors. The real story is that their main logistics business is in a really tough spot. So what are they doing? They're shrinking to focus, cutting costs like crazy, and leaning hard on their very stable property business to pay the bills while they reinvest to get stronger at home.
Which, of course, leaves us with the big, multi-million-dollar question. The surgery's been done, the company is absolutely leaner and more focused, but in this incredibly tough competitive world, is it actually strong enough to not just survive, but to start thriving again? Well, that's the one thing we'll all be watching to find out.